Welcome back to Property Deconstructed. I'm Pat Panetta from Tell Your Story Media and Mark Erichello from Master Advocates Real Estate Services. Now, we have spoken to Andrew, but we're rolling into another episode because we're going to sort of focus. So for those just joining us, Andrew Date is here, founder and director of the Industry Insider Buyers, Vendors Advocacy and Property Management. Andrew, thank you for coming back.
Thanks, Pat. Thanks, Mark. Great to be here.
Yeah, welcome. Thanks for spending more time with us. Episode 8 with Andrew Date.
Episode 8 with Andrew Date. Now, we're focusing on the market here. There's a lot of buzz around the current market, Victoria, changes to stamp duty, there's rent, there's all sorts of stuff going on, Mark. Please take us through it.
Yeah, lots of, noise and interference to cut through. We've got on the first Tuesday of each month, we've got the Reserve Bank decision on the cash interest rate. So that's always on everyone's mind each month. So that's a big decision coming up as well.
And at the time of recording, it's looming. The next decision is not too far away.
Correct.
So we're not quite sure whether they'll do it or not. I know you have your thoughts on it, and Andrew does as well.
It'd be great to get Andrew's thoughts. And then we've also got Victorian state budget announcements recently regarding land tax and other matters. And it all has a small effect on the sentiment of some buyers or a certain group of the market. Andrew would like to share some of your opinion on that if we can expand.
It certainly does. And I think the word that you said, Mark, that stood out for me was noise. There's a lot of noise. That noise leads to uncertainty. And the RBA do meet tomorrow. And I believe that they will raise rates based off where inflation is currently at. And it does affect buyer confidence, not across all markets. It affects some markets differently. I feel like there's a lot of buyers waiting in the wings to see when interest rates are going to stop rising and then potentially come back down. When they do, they're probably going to jump back in. I feel like if everyone's jumping back in at the same time, the market could potentially take off quite quickly.
So it's Monday the 5th of June. We'll just establish that. The meeting's tomorrow with the RBA.
Yes.
Andrew's feeling is that they will go for another rate rise. I have heard that they may watch it and rest it for a while. Where do you sit, Mark?
At the moment, I think a responsible decision would be to hold and wait and give it some time for people to adjust and get their advice and actually see how it rolls out into the market. Doesn't mean that that's what's going to happen. There's been lots of decisions by the RBA that many don't agree with, don't envy their job, but I'd say it's harder to pick than a broken nose that some good friends have actually referred to in the past with property. Time and experience, just because historically a sentiment's gone one way doesn't mean it's going to happen again in the future. People could be feeling like even if there is another rate rise, we may be near the last one. I think the review of the structure of the Reserve Bank that was discussed, that inquiry, that it may have fewer meetings a year, I think that was probably one of the best suggestions that came out of it, because at least it's not every month. You know, how can you monitor the outcome of a decision within 30 days? People don't even have time to come up for air.
Because there's always a lag, isn't there, when things happen, you know, every 30 days.
The lag effect. So we're at 3.8% now as a cash rate, and I think there's probably 0.8% that hasn't been really passed through to majority of the borrowers. So I agree with Mark that they may sit on the sidelines and wait to see what the data says in another 30 days, but my gut feeling is they're going to raise rates again.
So what does this mean for your clients? You're an independent advisor, you're operating on the side of the buyer. Interesting, you said in the last episode, Andrew, that it's sort of weighted towards the seller. So that's why you need someone who knows what they're doing. Otherwise you might just wake up and think, oh, I've just been shafted because I don't know what's going on. So anyway, what advice do you give to your customers in this sort of environment?
Well, one of the things we do when we're helping our clients, especially in the owner-occupier space, is try and remove the emotion from the equation and really break it down so they understand why and how we're evaluating a property. When you see a real estate agent list a property for 1.5 to 1.65 million and you don't buy property for a living, how do you know where to offer? It really starts with the land value, the location, the orientation on the block, the fundamentals of the property that you can't change. They're the things you need to get right when you're buying property.
And good point. When there aren't enough comparables, you're judging based on what properties you know work long term. Real estate's not a short game either, so you can assess the land and the actual asset or the building, quantify that and the potential. But long term, knowing the micro areas of a suburb, the types of properties that appeal and hold long term and that are a better long term investment is a smarter game, rather than looking at changing your decision or reacting short term to sensational media or decisions by the people that we've trusted and voted into power. With regards to shifts in the market, I think that there still will be a percentage. We talked about a third before. I commented, Andrew was making about a third of the market under mortgages. You might want to elaborate on that as well.
Yeah, across Australia, a third of the market rent, a third of the market own a home unencumbered, so outright, they've got no debt against the property, and then roughly a third of the market have a mortgage. The people that are susceptible to all of these rate rises are people who are highly leveraged in the last 2-year period when rates were 2%. Say you borrowed $1 million, for example, in 2020 and you paid 2%, interest on that's only $20,000 a year. That same debt level on interest only is $60,000 or $70,000.
Right.
So it's a big jump. It's 3 times. And then as you go up the ladder in terms of price points, if you've leveraged too high and you're not prepared for the changes that are here, you may have to sell.
So that's one of the criticisms, isn't it, of the Reserve Bank,
Yes.
that only a third of people out there
Being punished.
have mortgages, and only a portion of that third are the ones that might have leveraged a bit too high. So we're punishing that sector so we can slow the economy down. So we've got the sledgehammer just, hitting it over a few people's heads and hoping that they'll spend less to bring inflation down.
That's right. And the disappointing thing is most of that market, that third we're talking about, made a lot of their property decisions based on the confidence of advice from the Reserve Bank stating that it should remain on hold for a few years. Now, look, we always advise clients we should buy and hold for a long-term plan or a minimum of a decade for the right type of asset to see some maturity, see some return, some growth, add some value in between, right? If you're buying and you may be forced to sell in a market that's not prime or not ideal, then you're going to suffer if you're forced to sell within a few years. So they shouldn't have purchased really with that short-term outlook. If there was risk, if there was change, you shouldn't trust everything the government states.
Well, that's true. That's the thing, isn't it? So just because it was said we're all adults, we need to make our own decisions, but you are influenced by what the boss of the Reserve Bank is saying.
Definitely, yeah. And if they haven't got the experience, then you can see how they would have taken that advice as gospel when it's not definite.
I'd heard that it was a bit of a throwaway statement, that he sort of said it in passing that we'll keep the interest rates. I know it's yesterday's news, that we won't move interest rates. But then it gained momentum in the media and everybody reported on it, and they never came out and sort of backed away from it. But it was a little bit of a throwaway statement.
Like Mark said, you've really got to understand your own cash flow. Everyone's got different income levels. And if you've leveraged too high and you're not prepared, there's going to be a bit of pain. But if you're leveraged high and you've got money in an offset account, you're going to be able to weather the storm. Because I think the storm might only be here for 6-12 months because rates will have to come down to stimulate the economy, because right now the economy is stalling.
It might go backwards and we're in trouble. That's right. So it's a long-term game. So just off the back of that comment, you might get in now and find yourself a winner in 12 months, 24 months.
Potentially, yeah. Or like to take a little bit less risk, sometimes compromise a little bit still. If you've got your ideal suburbs that you want to live in, but sometimes you might look at compromising to the border suburbs or maybe a little bit less land but still acquire something. That's other ways to mitigate some risk as well long term, where you're not forced to your limit just because you can borrow that amount.
When we talk about where the market's actually heading, a lot of this sentiment is going to do with the supply. So right now, I've never seen such record low supply across the board. Certain council areas are just so low for buyers to choose from, and that supply has put a bit of a floor under the market. So the market, I believe, would have fallen further if we had an annualized normal rate of supply to the market. So if we do see supply increase dramatically, prices, I think, will go through a bit of a dead cat bounce or a false dawn. The last 3 months, the data is reflecting that we're starting to rise again. If we see an increased supply of listings, which may not happen, but if we do, then the market could head down again.
Because there's more to choose from, so the prices sort of won't go up.
And for certain sectors, like in our last episode, one of the reasons for low supply is that some vendors, if they don't have to sell, and they don't think it's a great opportunity for price, they'll hold back. In affluent suburbs, you saw that even during COVID and during lockdowns as well. Also with regards to more than 50% of mortgages at the moment have come to their anniversary of their fixed rates. And between February to October, you're going to see possibly units, apartments, or people that can't hold the mortgages at 5-6%. They may flood the market first.
So is that what you're saying, Andrew? The supply will go up
in certain property types,
with this change from variable to fixed.
Yeah, the supply should increase, but again, it's not going to be a contagion effect. I think it's going to be a small percentage of the market that are affected, and it'll be those people that weren't prepared for the changes coming.
Creating a disincentive to invest or rent in Victoria after the budget, are they doing the property market a disservice by land tax and doing all this stuff that they're doing?
Definitely, and we've discussed this a few times, Andrew and I, that you need to be incentivising the private market property investors to bring in the supply, especially if the rate of migration, people need to go somewhere, and if there's no choice and the rental yields are going insane, there needs to be more incentives in the long-term gain for the private market.
People have to live somewhere. The government say that they might build government housing, but I think the private sector will cope with that better than some sort of airy-fairy idea from a government body is sort of my feeling on that.
Far behind with the supply for social and government housing, but they do need to invest more.
Yeah, pre-2017, one of the incentives for investors was no stamp duty on brand new property. If they brought that back, that could be an appetite for investors to get back into the market. But right now, it's not a good picture because rental yields don't look like they're going to stop if inflation keeps rising and property investors are not incentivised to get into the market.
So that's a concern for all of us.
Yeah, it is, and I think it's something that'll be watched closely, and more voices that are experienced to advocate for a change there, I think is important.
Now, there's one important question
Well,
for
I'd
Andrew.
like to wrap up on a happy note or a lighter note, but yeah, go ahead.
Well, I heard you guys talking about your holiday, or is going away somewhere?
I'm like half of Victoria, leaving in winter. So I'm heading to Noosa with my family. There's 14 of us going to Noosa for a bit of a break, which will be nice. We've just hired a house not far from Hastings Street. So that's family time. And then lucky enough in July to be going to Fiji for a business conference. So I'm always looking to grow and develop. I'll be around a bunch of, I think there's 50 business owners, and it's about always growing and evolving and innovating. So I'm really excited for that.
So do you work from Fiji? I guess you're still working and talk to clients and stuff. You're at a conference.
Yeah, I've got a team on the ground, but I'll check my emails morning and night.
14 family members in Noosa?
My mum, my dad, my brother, my sister, their partners,
pretty cool.
the kids, my partner, her daughter.
Chase the sun during winter, which is good. One holiday's at least relaxing and regenerating, and then another for business as well.
Yeah, 100% balance is what it's about.
So true. And we all learn that the hard way, don't we? We sort of burn ourselves out working so hard, and as you get a bit older, you think, well, you've got to work smarter, not harder. Is it the first time you've taken a big family holiday with everybody?
2012, we had a smaller holiday. We used to have an Easter trip, and it was only 3 days, and I started that 6 years ago, an annual Easter trip. And I said to the family last year, it's not long enough. It's back to my turn this year, and I said, let's go away longer, and let's go somewhere warmer in winter. And they all brought in, so I'm very happy.
Italian background, your heritage, yeah. Oh, well, there you go.
Yeah, it is. We're both born here. You're
same
born
with
here
me,
as well, but you get the culture rubs off.
Okay, well, send us a postcard. Do they do that anymore? No, we'll send us a text, a photo, a video from Noosa. Thanks for your time, mate. It's been very informative. Those last 2 episodes have been wonderful. So, Mark, another great guest that you brought in for us here at Property Deconstructed.
Thanks, Andrew, from Industry Insider again. Pleasure having you on. Thanks for sharing all your collective wisdom.
Thanks, Mark. Thanks, Pat. Maybe one day I can come back.
Yes, absolutely. Book it in. Thanks for joining us on Property Deconstructed.